All right, everybody. Hope everybody's doing great out there in Forex trading land. And I'm putting together this very short video series. It's going to be 3 videos called How to Trade Forex in 3 Easy Steps. And what we're going to do is talk to you about the 3 deadly sins of Forex, or the 3 areas in Forex that you need to learn how to master. Okay, so here they are. And in this video, we're going to actually go over number 1, but here they are in 3 steps. The first step is property equity management and risk management. Step number 2, proper entry and exit of trades. And 3, my favorite, how to manage the trade once you're in. So let's talk about, in this really quick video, how to properly manage your equity and risk when you're trading Forex, okay? Now I'm going to suggest you never trade more than 2% of your account balance on one given trade, okay? And what that's going to mean is, let's say you've got an account with $1,000 in that account, okay? And let's say you take a trade. In fact, let's just show you on the charts. Let's play here. What were we at here? This trade is I got in this trade actually at 66.67. I'm actually up right now a little bit. We'll end up taking this trade all the way up here. But let's say that we are going to take a 100 pip stop loss. The reality is, this trade, we have a stop loss down into actually, I don't know where our stop is right now. I haven't looked at my daily update. But we're going to say that we're taking a 100 pip stop. Okay, just for numbers' sake. Okay, right in here. Now, the reality is, we're going to actually take a stop, and we'll talk about in video number 2 about proper entry and exit points. Okay. But we would actually take a stop below the swing low here. But let's just, for math's sake, say that we have a 100 pip stop. Okay. Now, let's say you have a $1,000 account, US dollars, and you're willing to risk 2%. That means if that trade goes against you, if that trade would hit your target, it didn't go up, instead it dropped down and took you out. Okay. If that happened, then the worst thing that you did is lost 2% of your account balance, or $20. Okay? You can live another day at 2% at a time. And 2% actually is pretty aggressive, guys. But let's say that's what we're doing. So what you need to do is calculate the number of pips. You have a 100 pip stop loss, and divide that between the number of lots. So you're willing to risk $20. You have to spread $20 between 100 pips. So what you can do is you can trade, you're willing to lose 20 cents per pip. So you'd be trading 2 micro lots. A micro lot is worth, most currency pairs, yen cross pairs, it varies, but it's pretty close to 10 cents per lot per pip. So you would trade 2 micro lots. Okay? At 2 micro lots, every time this trade would go down against you in the negative, you're losing 20 cents. Now, you haven't lost until you get stopped out or you close the trade. Once it goes all the way down to your 100 pip stop loss, you lost $20, you lost 2% of your trade. It's not a big deal, you can move on. But let's say that price moves up 100 pips. All right? What happens then? Well, it's going to be the same effect. If you're willing to risk 2% of your account balance between 100 pips, then if the price moved up 100 pips, what are you going to get? You're going to make $20, 2% of your account. So let me look at a different chart here. And I want to show you a trade that we actually took yesterday. Was it the CAD yen? Yes, it was. Actually, hold on a second. Let me be sure that's the right trade that we took here. Let's look at here. Yep, that was it. Okay. So what we did a few days ago, I took a trade right here at 8,200. Okay, we'll turn this blue. And we put a stop loss, a very tight stop loss on this trade, because price had really been coming down to this point and having a difficult breaking time. We actually had a stop loss at 81.69 here. Really tight stop. Okay. And we put our profit target right here at 82.90. Okay, so we'll color this one green. So you can see the colors. Okay, blue is where we wanted to enter the trade. So when price was up in this range here, I put a buy limit order. That means we put the order in advance. We waited for price to drop down to our mark. There was our stop. You can see price broke through a little bit, did not hit our stop, then drove up, and then very next day we closed out that trade. All right. Actually, that day, it came in one day. It came down, hit our price, and took us up, and we closed out. Now, we had a 31 pip stop loss. I leveraged 2% of my account balance between 31 pips. That's a very tight stop. I rarely take those really tight stops, but in this case, this pair had multiple times come down to this level and had a difficult time breaking through, and so I took it. So let's just round it off. 30 pips. 2% had to be spread between 30 pips. But the currency pair literally moved 90 pips. So if this trade would have went against me right here, which it did not, okay, we would have lost 2%. So what happens if it moves up 30 pips? Then we gained 2%. Now the reality is we gained it, went up 9%, 90 pips. So when we closed this, we got in this trade in and out in one day, and we made right here a 6% profit on this trade. Okay, so here's the rules again. Do not leverage more than 2% of your account balance at any one given time. If you're trading large swings like I do with 100 to 200 pip stop losses, if you have an account balance less than $10,000 US, you want to set up with your brokerage account to use micro lots, or what they call super mini lots at some brokerage firms, that are 10 cents per pip per lot. Okay? And try not to be in more than 5 to 6% of your account being traded at once. So if you're trading 2% at one given time, all right, then if you're in 10 different trades, and all those trades go against you at one time, you're going to lose 20% of your account balance. I wouldn't risk more than 6%. Now sometimes I do go higher than that. Sometimes I'm in 8 trades at once, and I may have 10% of my account balance leveraged. But I have very tight a very tight trading system that has a long proven track record. My win to loss ratio is very, very good. Now here's another thing we need to think about, and this is why this trade is really good. I don't always adhere to this rule, but I try to as much as I can adhere to the risk to reward ratio of 1 to 2. So, in other words, if I have a 30 pip stop loss, I'm looking that I expect this trade to go up at least 60 pips. You understand? Because if you have that ratio on the majority of your trades, you can actually lose most of your trades and still be profitable every month, because your wins are twice as big as your losses. Okay? And we'll get more into that, into managing the trade a little bit later here. But so in this case, we have a 31 pip stop, so let's just say 30, and we had a 90 pip gain. We actually had a 1 to 3 risk to reward ratio. All right? So anyway, back to the whole game plan. Equity management is key. It is the #1 reason why 90% of Forex traders get their butts kicked. If you want to survive, stop leveraging large amounts of your account at one time. 2% account balance, maximum risk of your account balance per trade. Always use a stop. Look for a 1 to 2 risk to reward as much as you can. And that's that for equity management. Now that's a simple game plan, and in fact, if you go to our YouTube channel right now, we have an entire two video training series on how to manage your equity. It's a lot more in depth than this video, but this is video #1, and the next video is section #2 of how to trade Forex in 3 easy steps, which is proper entry and exit points.